Hi, I'm Jennifer with Tax TV, here with an overview of the various tax-deferred reorganizations, or reorgs, available for corporations. Section 368 of the Internal Revenue Code offers corporations a variety of merger and acquisition structures that are generally not considered taxable at the time of the transaction, instead deferring the taxable event to a later time. The rationale is that these transactions are viewed as acceptable changes to the corporate existence of the business, as well as a continuation of the taxpayer's investment. Corporate reorganizations are typically broken into three categories: those where the corporation grows, those where the corporation is divided up, and all others. Many of them are referred to by the letter code in Section 368, such as Type A, B, C, and D reorgs. The structures are strictly defined, and if applicable, the transaction must be characterized as tax-deferred, since this is not an elective treatment. Acquisitive transactions take place through acquiring the stock or assets of another corporation, or through a direct statutory merger of two corporations, which is commonly referred to by tax professionals as a Type A reorg. The Type B reorg is a limited form of stock-for-stock acquisition in which the purchaser acquires the target company's stock solely in exchange for the purchaser's voting stock. To qualify, the purchaser must control 80% or more of the target company's voting power and total shares of each class of non-voting stock. Type C is another acquisitive transaction, a stock-for-asset purchase where the purchaser acquires substantially all of the target company's assets solely in exchange for the voting stock of the purchasing company. The target company generally needs to liquidate and distribute the stock to its shareholders following the transaction. Two other interesting forms of acquisitive transactions are generally referred to as triangular mergers, either forward or reverse. These are sometimes used when an A, B, or C reorg becomes too difficult to effectuate, mostly because of regulatory or corporate governance hurdles. They both involve the purchaser forming or using a subsidiary to merge with the target. The only difference between them is, in a forward triangular merger, the subsidiary of the purchasing company remains and the target company disappears. And in reverse triangular merger, it is the target company that remains and the subsidiary that disappears. Another group of transactions are those where a corporation gets divided up, such as spin-offs, split-offs, and split-ups. These types of transactions pose extremely complicated tax issues to consider, including how debt is split up and how stockholders allocate the basis of their investment. The last group of reorgs covers everything else. These include Type D, E, F, and G. Type D involves a transfer of all or part of the company's assets to another controlled corporation, with control meaning 80%. Type E is a recapitalization transaction where a corporation's shareholders exchange their interest for other equity or debt interests. The third type is where there is merely a change in identity, form, or place of the organization of one corporation. The last type is the transfer of all or part of one corporation to another as a part of a bankruptcy proceeding. For more detailed information about corporate mergers, acquisitions, and reorganizations, search taxtv.com.